Today, we are covering one of the biggest global stories right now, the growing tension between Iran and the United States, and more importantly, how this is affecting you. This is not just news, it is a direct influence on your financial future. What is happening today in the Middle East has roots that go back decades, and the consequences are arriving at our doorstep in India. We need to look beyond the headlines and understand the deep economic mechanics at play. This is your masterclass on the Iran-USA crisis. Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. Today, we dive deep into the Iran versus USA conflict and its direct impact on India. If you want to understand the global economy without the noise, you are in the right place. We are going to break down everything from geopolitical history to your monthly grocery bill. Let's start by understanding the problem, the deep roots of this tension. To understand today, we must look at the past. The friction between Iran and the United States didn't start yesterday. It has deep roots in the 1979 revolution and the subsequent decades of sanctions and diplomatic standoffs. We've seen periods of relative calm followed by intense escalation. The 2015 nuclear deal was seen as a breakthrough, a moment where it seemed the world might move towards stability. But with the withdrawal of the US from that deal in 2018, the landscape changed once again. Sanctions returned, and Iran's economy was pushed to the brink. This history of maximum pressure versus strategic resistance has created a volatile equilibrium that is now being tested. We are seeing a collapse of trust that makes peace talks incredibly fragile. When talks fail, as they have recently, the market doesn't just react to the news, it reacts to the uncertainty of what comes next. In a world of globalized trade, no country is an island. The instability in the Persian Gulf is a signal that ripples through every stock exchange from New York to Mumbai. We are watching a historical pattern repeat itself, but with higher stakes than ever before. Understanding this history is the first step in identifying the problem of our masterclass, the inherent instability of our global energy supply chain. We are reliant on a region that has been a geopolitical tinderbox for half a century, and when that tinderbox catches fire, the smoke reaches us first. Why have talks collapsed now? It's a complex web of regional influence, security guarantees, and economic survival. Iran seeks the lifting of sanctions that have crippled its oil exports and frozen its international assets. The United States, on the other hand, demands curbs on regional activities and long-term nuclear guarantees. Neither side is willing to blink first. This deadlock is what fuels the current market anxiety. We see reports of shipping routes being threatened and ceasefire attempts falling through. Every failed meeting is a green light for oil speculators to drive prices higher. For India, this deadlock is a direct threat to our fiscal math. We are the insight phase of our masterclass here. The realization that our domestic progress is tethered to diplomatic outcomes we don't control. We must realize that the problem isn't just a war, it's a structural vulnerability in how the world moves energy. The Strait of Hormuz is the physical manifestation of this vulnerability. It is a narrow passage through which 20% of the world's total oil consumption passes. Think about that. 1 out of every 5 barrels of oil consumed globally goes through this tiny strait. If tensions lead to a disruption here, the explanation for rising prices becomes very simple. Supply vanishes while demand remains constant. This is not just about Iran and the USA, it's about the security of the global commons. As an investor, you must understand that the strait is the pulse of the oil market. When the pulse is steady, the world grows. When it falters, everyone feels the pain. We are now entering a period where that pulse is becoming irregular. This is the realization moment for India. Our energy security is a hostage to Middle Eastern stability. It's a reality that the RBI and our government are forced to manage every single day. The collapse of peace talks is not just a headline. It's a warning shot for our economy. Let's bring this home to India. Why are we so sensitive to this? The math is straightforward but brutal. India imports more than 80% of its crude oil requirements. We are one of the world's largest consumers and importers of energy. Every time the price of a barrel of oil increases by $1, our import bill grows by thousands of crores. This is money leaving our country, putting pressure on our trade deficit and our currency. When oil prices spike, the demand for dollars increases as we need more of them to pay for the same amount of oil. This naturally leads to a weaker rupee. A weaker rupee, in turn, makes everything else we import more expensive, from the chips in your smartphones to the machinery in our factories. This is the explanation for why your lifestyle costs are tied to the Persian Gulf. The RBI has been very vocal about these risks. They highlight three major concerns: inflation, growth pressure, and massive macroeconomic uncertainty. If the government has to spend more on oil, it has less to spend on infrastructure, healthcare, and education. It's a trade-off that affects the quality of life for 1.4 billion people. We are interconnected in ways that most people don't realize until they see the price at the petrol pump change. But as we've seen, it doesn't stop at the pump. The insight here is that energy is the foundation of our economy. When the foundation is unstable, the whole house shakes. We must look at our strategic petroleum reserves and our shift to renewable energy as long-term solutions. But in the short term, we are at the mercy of global crude prices. This is the reality we must navigate as informed citizens and smart investors. We are not just spectators. We are participants in this global economic drama. The tension between Iran and the USA is a direct challenge to India's dream of becoming a $5 trillion economy. It forces us to be more efficient, more strategic, and more resilient. But to do that, we must first understand the mechanics of how this impact reaches our daily lives. Let's trace the journey of high oil prices through the Indian economy. It starts at the port. Crude oil arrives, is refined, and then distributed as petrol, diesel, and gas. Diesel is the fuel that powers India's logistics. Every truck carrying groceries from a farm in Punjab to a market in Delhi, every cargo ship bringing components to our factories, every delivery bike in our cities, they all rely on fuel. When diesel prices rise, transport costs go up immediately. This is not a cost that logistics companies can absorb for long. They pass it on to the wholesalers, who pass it on to the retailers, who finally pass it on to you. This is the explanation of the ripple effect. Even if you don't own a car, you are paying for high oil prices every time you buy a kilo of tomatoes or a loaf of bread. The cost of moving things is a hidden tax on everything we consume. We are seeing this now as crude remains volatile in the mid-90s range. Each rupee increase in fuel acts as a drag on the economy. It reduces the disposable income of the average Indian family. If you're spending 500 rupees more on fuel every month, that's 500 rupees less you have for savings or other consumption. This is the problem at the micro level, the erosion of purchasing power. For small businesses, this is a margin squeeze. They can't always raise prices because they fear losing customers, so they take the hit in their profits. This is how a geopolitical conflict thousands of miles away can lead to a local business in your neighborhood struggling to stay afloat. We must realize that the economy is a giant machine, and fuel is the lubricant. When the lubricant becomes too expensive, the machine starts to grind and slow down. Understanding this realization moment that logistics is the core of our inflation is key to managing your own finances during these times. It's why we see the government being so careful with fuel taxes. They know the political and economic cost of high diesel. As we move forward, we need to look at how this impacts specific sectors, especially those that are the backbone of our daily life. One of those is the food industry, where the impact is most visible and most painful. The most direct impact for the common person is on food. Why do vegetable prices rise when oil prices go up? It's the farm-to-plate logistics. Most of our vegetables are transported by diesel trucks from rural areas to urban centers. High diesel means higher freight charges. When a farmer spends more on transport, the cost of the produce at the mandi increases. This is why you see food inflation tracking oil prices so closely. But it's not just groceries. Think about your local restaurant or the street food vendor you visit. They use commercial LPG and cooking gas. If these prices rise due to global energy tensions, their operating costs spike. They face a difficult choice. Raise the price of your favorite meal, reduce the portion size, what we call shrinkflation, or accept lower margins. Most small businesses, from cafes to bakeries, are already operating on thin margins. A global conflict can push them into the red. This is the realization moment for local business owners. They are part of a global supply chain whether they like it or not. The explanation of local inflation is often found in global geopolitics. For the consumer, this means your monthly budget is under constant pressure. It's not just about luxury spending, it's about the essentials. This is why the takeaway for our masterclass is to build a financial buffer. We cannot control the price of oil, but we can control our reaction to it. We can choose to be more mindful of our spending and more strategic with our savings. For a business owner, this is the time to look for efficiencies, to find ways to reduce waste and optimize logistics. The struggle of local businesses during these times is a testament to the interconnectedness of our world. A failed peace talk in a distant capital can lead to a quiet cafe in an Indian suburb having to let go of a staff member. It's a sobering thought, but it's the reality of the 21st century. As we transition to looking at the stock market, remember that these micro impacts are what drive the macro sentiment. The market is just a reflection of millions of these individual stories of struggle and adaptation. Understanding the local impact gives you the insight to predict how the broader market will move. If the average Indian is feeling the pinch at the grocery store, it won't be long before the corporate earnings of FMCG companies start to reflect that reality. This is the holistic view we aim for at Yearn to Grow. We don't just look at charts, we look at life. Now let's talk about the big question. How does this affect the Indian stock market? Markets, by their very nature, hate uncertainty. Geopolitical tension is the ultimate form of uncertainty. When the Iran-USA conflict escalates, global investors move into risk-off mode. This means they pull money out of emerging markets like India and move it into safe havens like gold or US treasuries. This is the explanation for the heavy selling we often see from foreign institutional investors, or FIIs. They have reportedly pulled significant money from Indian equities during this period of tension. This selling creates sudden corrections and high volatility. You see the red on your screen, and your first instinct might be to panic. But wait, there's another side to this story. While FIIs are selling, our domestic institutional investors, or DIIs, and retail investors through SIPs are often the ones buying. This is the tug of war that defines our market today. The insight here is that India is no longer solely dependent on foreign capital. Our own domestic savings are being channeled into the market, providing a cushion against global shocks. However, certain sectors are hit harder than others. Sectors like paints, aviation, and logistics are oil sensitive. Since oil is a major raw material for them, a price hike directly impacts their profitability. If an airline has to spend 10% more on fuel, their bottom line shrinks unless they raise ticket prices, which might reduce demand. This is the problem for oil-dependent stocks. But as a smart investor, you must look beyond the immediate red. Volatility is not the same as risk. Risk is the permanent loss of capital. Volatility is just the market's way of breathing. The realization moment is that these dips are often driven by fear rather than fundamentals. The Indian economy's long-term story remains intact. This tension is a temporary hurdle, not a roadblock. Understanding this allows you to stay calm when the headlines are screaming. You realize that a correction is just a chance for the market to reset and for quality assets to become available at better prices. This is where we move from the problem to the opportunities. Panic is never a strategy. Patience is. Let's look at how you can use this volatility to your advantage. During periods of geopolitical crisis, we see a phenomenon called sector rotation. Smart money moves from vulnerable sectors to resilient ones. While oil-dependent industries like aviation and paints might face pressure, other sectors like information technology or pharmaceuticals may remain relatively unaffected. In fact, some sectors might even benefit indirectly. This is the explanation of market resilience. As an investor, your job is to identify these patterns. History shows us that during global uncertainty, defensive sectors often outperform. But more importantly, history shows that geopolitical dips are usually short-lived. The insight is that the market often overreacts in the short term. Fear is a powerful emotion, and it can drive stock prices far below their intrinsic value. This is the realization moment. For a disciplined investor, red is the color of opportunity. Think about the companies you've always wanted to own, but thought were too expensive. A geopolitical correction might give you the clearance sale you've been waiting for. This doesn't mean you buy blindly. You must watch patiently. You look for businesses with strong balance sheets, pricing power, and visionary leadership. These are the businesses that will not only survive the crisis, but come out stronger. This is the takeaway for the smart accumulation phase of our masterclass. Use the fear of others to build your own wealth. We often say at Yearn to Grow that wealth is built in the dips and realized in the peaks. But to do that, you need a stomach for volatility. You need to understand that the problem of the Iran-USA tension is a macro event, but your portfolio is a micro choice. You can choose to be diversified. You can choose to have some cash on the sidelines. You can choose to stay focused on your long-term goals rather than the daily fluctuations. By understanding the why behind the market movement, the explanation we've discussed, you can move from a place of anxiety to a place of strategic action. The market is a transfer mechanism from the impatient to the patient. Which one will you be? As we look at the specific tactics for investors, remember that time in the market is more important than timing the market. But a little bit of timing during a crisis can certainly help your returns. One of the greatest tools in your arsenal is the SIP, or systematic investment plan. In times of high volatility like the current Iran-USA crisis, the SIP becomes even more powerful. Why? Because of Rupee cost averaging. This is the explanation of why you should never stop your SIP during a market crash. When the market falls, your fixed monthly investment buys more units of a mutual fund. When the market eventually recovers, and it always has historically, those extra units translate into significant wealth. This is the realization moment for many investors. The dip is actually your friend. If you had stopped your SIP during previous crises, you would have missed out on the recovery that followed. The takeaway here is simple. Stay disciplined. Don't look at your portfolio every day when things are red. Trust the process. This is also a great time for asset allocation. If your equity portion has shrunk due to the market dip, it might be time to rebalance by moving some money from debt to equity. This is buying low in its most systematic form. Smart investors don't try to predict the bottom. They just wait for fear to make things cheap. We call this smart accumulation. It's about having the courage to stay the course when the world feels like it's falling apart. Remember, the problem of geopolitics is temporary, but the solution of compounding is permanent. At Yearn to Grow, we believe that financial freedom is a marathon, not a sprint. A 25-minute masterclass like this is meant to give you the stamina for that marathon. We've looked at the history, the oil mechanics, the logistics impact, and the market reaction. Now, you have the full picture. You have the insight to see through the panic. You have the explanation to understand the ripple effects. And hopefully, you have the realization that you are in control of your financial destiny. But before we conclude, we must look at the scenarios that could unfold from here. Being prepared means having a plan for what if. Let's look at the 3 most likely outcomes and how you should position yourself for each. Because in the end, clarity is the best antidote to fear. We need to talk about the rupee. It's the silent victim of high oil prices. As we've discussed, India imports most of its oil in dollars. When oil prices spike, our demand for dollars surges. This creates a classic supply-demand imbalance, leading to the depreciation of the rupee. This is the explanation for why your foreign travel, international education, or even that imported gadget becomes more expensive. But the impact goes deeper. A weaker rupee widens our trade deficit, the difference between what we export and what we import. To manage this, the RBI often has to intervene. They might use their foreign exchange reserves to support the rupee, or in extreme cases, they might have to raise interest rates. This is where the problem hits your home loan. Higher interest rates mean higher EMIs. It's a chain reaction that starts in the Persian Gulf and ends in your monthly bank statement. This is the realization moment. Your personal debt is connected to global geopolitics. Understanding this insight helps you plan your finances better. If you see sustained high oil prices, you might want to avoid taking on new variable rate debt. You might want to lock in your rates or focus on paying down high interest loans. This is the practical side of finance that we emphasize here at Yearn to Grow. We want you to be macro aware. By watching the rupee and the oil price, you get a head start on what the RBI might do next. This isn't just theory, it's about protecting your wealth. A weaker rupee also impacts Indian companies that have borrowed in foreign currency. Their repayment costs go up. This is another reason for the stock market volatility we discussed. We are seeing a complex web of financial dependencies. But don't let it overwhelm you. The takeaway is to maintain a diversified portfolio that includes assets like gold, which often appreciates when the currency weakens. Gold acts as a hedge against both geopolitical risk and currency depreciation. By building a financial fortress that includes different asset classes, you can withstand these macroeconomic tremors. We are not just looking for growth, we are looking for resilient growth. This is the core of our philosophy. As we prepare for the different scenarios, keep this rupee equation in mind. It is the bridge between global events and your personal wallet. Let's move to the scenario planning so you know exactly what to watch for in the coming weeks. Let's look at Scenario 1. Peace talks resume and a resolution is reached. This is the outcome everyone is hoping for. In this scenario, the immediate threat to the Strait of Hormuz vanishes. Oil speculators pull back and crude prices cool down, perhaps returning to the $70 or $80 range. This would be a massive relief for the Indian economy. The explanation for the recovery would be an immediate improvement in our fiscal outlook. The rupee would stabilize and the fear of imported inflation would subside. In the stock market, we would likely see a relief rally. The sectors that were hit hardest, paints, aviation, and logistics, would likely lead the recovery as their raw material costs drop. This is the realization moment for those who bought during the dip. Your patience is rewarded. The takeaway for this scenario is to stay invested. If you have been accumulating quality stocks during the tension, this is when you start to see the gains. But even in a recovery, we must remain disciplined. Markets often overshoot on the upside just as they do on the downside. The insight here is that peace is the ultimate driver of global growth. For India, a stable Middle East means we can focus back on our domestic reforms and infrastructure building. Our export growth would benefit from a more stable global environment. This is the scenario of normalization. However, we cannot bank on it. We must also be prepared for the other possibilities. As an investor, Scenario 1 is your reward for staying calm. But Scenario 2 requires more stamina. Let's look at what happens if the tension continues without a full-scale war, but also without a resolution. This is the scenario of high volatility equilibrium. It's a more challenging environment for both the government and the investor. Let's break it down. Scenario 2 is prolonged friction. This is a situation where peace talks remain stalled, and there are occasional minor incidents in the Persian Gulf. It's a neither war nor peace state. In this scenario, oil prices don't crash, but they also don't spike to extreme levels. They might hover in the $85 to $95 range. This is the problem of sustained uncertainty. The explanation for the market's reaction would be a sideways movement. We would see continued volatility, with markets reacting to every tweet or news headline. For India, this means inflation stays sticky. The RBI might have to keep interest rates high for longer to guard against currency pressure. This is a test of your investor psychology. The insight here is that the market will get used to the noise over time, but the underlying pressure remains. For a business, this is the environment where efficiency is king. Only the most well-managed companies can maintain their margins when raw material costs stay elevated. This is the realization moment for the investor. You must be more selective. This is not a rising tide lifts all boats market. You must pick the winners, the companies with pricing power that can pass on costs without losing volume. The takeaway for scenario 2 is to focus on quality and diversification. This is where your asset allocation truly matters. Having some exposure to commodities or energy-focused funds might act as a hedge. It's an environment for the patient accumulator. You keep your SIPs going, you rebalance occasionally, and you don't let the daily noise distract you from your 5 or 10-year goals. At Yearn to Grow, we emphasize that time in the market is your biggest asset during prolonged friction. The world has lived through periods like this before, and the survivors were those who didn't let the uncertainty paralyze them. We are now entering a phase where the global economy is learning to live with geopolitical risk. But what if things go from bad to worse? We must look at scenario 3, the black swan event of a major escalation. It's the scenario no one wants, but every smart investor must prepare for. Knowledge is your only protection against a total market panic. Scenario 3 is the major escalation. This is the black swan event where tensions lead to an actual disruption in the Strait of Hormuz. In this extreme case, oil prices could spike above $100 or even $120 a barrel. This would be a massive shock to the global economy and a severe problem for India. The explanation for the market's reaction would be a deep correction. Panic would be widespread. FIIs would likely exit in a hurry, leading to a sharp drop in the stock market and a significant devaluation of the rupee. This is the scenario where your financial fortress is tested. The insight here is that such spikes are usually unsustainable. The world cannot function at those prices for long, and global pressure for a resolution would reach a fever pitch. But the short-term pain would be real. The realization moment is that this is the ultimate fear sale. While it feels like the end of the world, history shows that these are the moments when the greatest fortunes are built. But to do that, you need dry powder, cash on the sidelines that you are ready to deploy when others are panicking. The takeaway for scenario 3 is strategic readiness. You don't buy on the first day of the crash. You wait for the signs of stabilization. You focus on the must-have companies that are essential to the Indian economy, the ones that will inevitably recover because our country cannot function without them. This scenario requires the most discipline and the strongest stomach. We are talking about a stress test for your entire financial plan. If you have been following a disciplined asset allocation and have some hedge in gold, you will be much better positioned than the average investor. This is the preparation phase of our masterclass. We hope for the best, but prepare for the worst. By understanding all 3 scenarios, you take away the market's power to surprise you. You are no longer a victim of the headlines. You are a strategist. This is the level of clarity we aim to provide at Yearn to Grow. We want you to be the calmest person in the room when the world is in chaos. Let's bring all these lessons together and talk about your final investor playbook. Because knowledge without action is just information. But knowledge with a plan is wealth. So, what is your final investor playbook during this Iran-USA crisis? Let's summarize the takeaways. First, do not react emotionally. The headlines are designed to capture your attention through fear. Your plan should be designed to capture growth through logic. Second, stay disciplined with your SIPs. The volatility is your opportunity to accumulate more units at a lower cost. Third, check your asset allocation. Ensure you have a mix of equity, debt, and gold to protect against different risks. Fourth, maintain some dry powder. Having some cash on the sidelines allows you to take advantage of any black swan corrections. Fifth, focus on quality. In a high-cost environment, only companies with pricing power and strong balance sheets will thrive. This is the explanation of how you build long-term wealth. We've moved through the problem of geopolitics, the insight of India's vulnerability, and the realization that volatility is an opportunity. Now, the action is up to you. This masterclass has given you the deep dive context you need to look past the daily noise. You now understand the history, the logistics, the Rupee equation, and the market mechanics. You are no longer just an average investor. You are an informed investor. And in the world of finance, information is the greatest advantage. But remember, the goal isn't just to make money. It's to build a life of freedom and security. That's why we call this channel Yearn to Grow. We'll see you in the next video. If you found this helpful, please like the video, subscribe to the channel, turn on notifications so you do not miss future videos. We will continue breaking down finance and insurance concepts step by step. Stay informed, stay ahead. This is Yearn to Grow, signing off. Stay calm and keep growing.